Here with his take is Barry Knapp, Director of Research at Ironsides Macroeconomic, and you go into a lot of, I guess, second derivative type stuff. What higher energy prices actually mean for exports of certain company, imports,
right,
and currency effects that will minimize the inflationary impact and maybe allow the Fed to have stopped for good, which is what you say in your view. And then you see other disinflationary things like shelter, and I think you think the labor market's peaking at this point. Yep. So no more hikes is the bottom line.
No more hikes. And I think there's a good chance if we get a 0.2 print on core this morning that the Fed will actually drop the last rate hike dot, in the dot plot in next week's meeting. It's clear that a number of participants don't want to hike any further. Goolsbee, Bostic, Harker have all said they don't think they should hike anymore. But what's interesting about this whole energy dynamic is what made us first start running a current account deficit that pushed us off the gold standard in '71 was running big energy trade deficits. We first started consuming more than we produced in the late '60s. So if you think about those decades, the subsequent 5 decades, the decades where oil prices were high, energy deficits went up a lot, those were weak dollar decades. That was true in the '70s after we went off the gold standard. It was true in the 2000s when oil prices went to $150 a barrel. But in the periods where our production or supplies went up globally, like the 80s, 90s, and 2010s, the dollar was strong. That's because, again, it drove those big
current account deficits.
That all changed with shale.
Now we're back.
Now that we are an actual exporter of energy, the dollar now goes up with the price of oil. So this is a huge problem for China. It's a huge problem for Japan, Korea, Germany, because they used to get something of a buffer. If the dollar went down because oil's priced in dollars, it wasn't as painful as it is now. So now it goes up. So there's 2 big causes or events that happen as a consequence of this. One is that because we still import a lot of goods, the fact that the dollar's gone up cheapens those goods and is a big offset because our goods deficit's a lot bigger than our energy surplus. And the second thing is because it puts all this pressure on the Chinese RMB, the yen, it actually makes them better sellers of treasuries, which makes our rates go up. So there's 2 big
that helps the Fed
financial
not have to
condition
raise,
tightening effects that happen when energy prices go up. So, the bottom line is for this morning, the only element that's going to be going up of food, energy, non-housing services, so-called super core, shelter, or core goods is energy. So it's totally not a reason to worry about the Fed tightening any further. It actually, if anything, will get them to go the other way.
Did the last couple of hikes surprise you? You've been coming on saying it.
Yeah, I think it's been a major mistake. I mean, I've been describing the situation as an unstable equilibrium. So we have the household sector that has termed out their mortgage debt. The effective mortgage rate is something like 3.25. So most of the household sector is in pretty good shape. The low end is starting to struggle. The large non-financial corporate sector, again, has termed out their investment-grade credit debt. In good shape. The banking system and small businesses are really struggling with the deeply inverted yield curve. The curve's only been this deeply inverted 3 times in our history, 73, 79, and 80. That's the unstable equilibrium. The market expects the Fed to cut 100 basis points next year. I think they have to. Otherwise, we're going to have a huge credit availability problem.